Boom! Just like that, the market takes a nosedive. Your portfolio is probably flashing red right now. It's enough to make your heart skip a beat, but hold on. Before you hit the panic button, take a deep breath. We're going to break down exactly what happened, why it happened, and most importantly, what you can do about it. Because here's the thing about the market. It's a wild ride. There are going to be ups and downs. But with the right knowledge and a cool head, you can navigate these turbulent times and come out on top. So buckle up because we're diving deep into the heart of today's market crash. The perfect storm. What sent the market reeling? We're talking major indices like the Dow Jones, the S&P 500, and even the tech-heavy Nasdaq all taking a significant plunge. But what caused this sudden freefall? Was it a single event, or a confluence of factors that created this perfect storm? Spoiler alert, it's the latter. We're talking weak economic data, political uncertainty, and even whispers of technological disruption, all converging to shake investor confidence. Jobs, Trump, and quantum. Oh my, let's unpack this. Today, we dive into a whirlwind of economic news that has left everyone from Wall Street to Main Street scratching their heads. The latest jobs report, political maneuvers, and advancements in technology are all colliding in a perfect storm of uncertainty and speculation. First, we got hit with some dismal job growth numbers. The latest figures show a significant slowdown in job creation, which has economists and analysts deeply concerned. This isn't just a blip on the radar, it's a trend that could have far-reaching implications for the economy. Remember those rosy predictions of a booming economy? Just a few months ago, experts were forecasting robust growth and a strong labor market. But now those predictions seem overly optimistic, if not downright unrealistic. Well, they took a hit with a measly 122,000 jobs added in December 2024. This is a stark contrast to the numbers we were seeing earlier in the year, and it raises serious questions about the health of the economy. Investors hate uncertainty, and weak job growth screams uncertainty about the future of the economy. When job numbers fall short, it creates a ripple effect that can be felt across various sectors, from consumer spending to business investments. Then we have President-elect Trump dropping a bombshell, a potential national economic emergency declaration. This kind of announcement is unprecedented and has left many wondering what it could mean for the future. Now, details are still emerging, but the mere mention of this sent shockwaves through the market. Investors are on edge, trying to decipher what this could mean for their portfolios and the broader economy. Investors hate surprises, especially when those surprises involve potential policy changes that could impact their bottom line. The uncertainty surrounding this potential declaration is causing a lot of anxiety and speculation. And if that wasn't enough, the world of quantum computing decided to join the party. This emerging technology has been the subject of much hype and excitement, but recent developments have cast a shadow over its immediate future. NVIDIA's CEO cast a shadow of doubt on the timeline for practical quantum computers. This revelation has significant implications for the tech industry, which has been banking on quantum computing to drive the next wave of innovation. This sent shockwaves through the sector, with companies like Rigetti, IonQ, and other tech giants feeling the impact. The stock prices of these companies have taken a hit, reflecting the market's uncertainty about the future of quantum computing. The tech sector, which has been a beacon of growth and innovation, is now facing a period of uncertainty. As we navigate these turbulent times, one thing is clear. The intersection of jobs, politics, and technology will continue to shape our economic landscape in unpredictable ways. The domino effect, AMD, the Fed, and global jitters. In today's interconnected world, the stock market is a complex web of interdependencies. A single event can send ripples across the entire financial landscape, affecting various sectors in unexpected ways. But wait, there's more. The tech sector took another blow with AMD, a darling of the semiconductor industry, getting downgraded by HSBC. This downgrade sent shockwaves through the market, causing investors to rethink their positions in tech stocks. AMD has been a key player in the semiconductor space, known for its innovative products and competitive edge. However, the downgrade raised concerns about its future growth prospects and profitability. Remember, the market is like a giant game of dominoes. One event can trigger a chain reaction, impacting seemingly unrelated sectors. The downgrade of AMD didn't just affect tech stocks, it also had a ripple effect on other industries that rely on semiconductors, such as automotive and consumer electronics. Investors started to worry about the broader implications for the global supply chain and the potential for a slowdown in technological advancements. And let's not forget about the Federal Reserve. Governor Waller hinted at easing interest rates but downplayed the potential impact of Trump's proposed tariffs on inflation. The Fed's stance on interest rates is always a critical factor for the market, as it influences borrowing costs, consumer spending, and business investment. While the hint of easing rates was initially seen as a positive sign, the mixed messages about tariffs added a layer of complexity and uncertainty. This mixed messaging only added fuel to the fire of uncertainty, leaving investors wondering about the future direction of the economy. The conflicting signals from the Fed made it difficult for market participants to gauge the overall economic outlook. Some investors feared that the tariffs could lead to higher costs for businesses and consumers, potentially stoking inflation and slowing down economic growth. All of this is happening against a backdrop of global economic jitters. Trade tensions, geopolitical risks, and slowing growth in major economies are all contributing to a sense of unease in the market. The ongoing trade disputes between major economies such as the US and China have created an environment of uncertainty and volatility. Geopolitical risks, including conflicts and political instability in various regions, further exacerbate the situation. Additionally, signs of slowing growth in key economies like Europe and China have raised concerns about a potential global economic slowdown. Investors are left grappling with a multitude of factors, trying to navigate through the complexities of the current economic landscape. Gold shines, oil simmers, bonds whisper, reading the signs. Now, while the stock market might be in a frenzy, other assets are telling a different story. Gold, that safe haven asset, saw a price bump. It's like investors are seeking refuge from the storm in the glistening embrace of precious metals. Oil, on the other hand, remained relatively stable. The strengthening US dollar seemed to offset any potential gains from the market turmoil. And then there are bonds. The yield on the 2-year Treasury edged down, while the 10-year Treasury yield rose slightly. These subtle movements are like whispers, hinting at the complex interplay of factors influencing investor sentiment. Don't be a deer in headlights, avoid the panic sell. Okay, so the market crashed. It's a gut punch, no doubt about it. But here's the thing. Now is not the time to panic. Remember that old saying, don't make permanent decisions based on temporary emotions? That applies to the stock market more than anywhere else. Panic selling is the worst thing you can do right now. Why? Because you're essentially locking in your losses. Remember, the market is cyclical. What goes down must come up. And when it does, you want to be positioned to reap the rewards, not licking your wounds from a hasty sell-off. This is not the end. History's lessons in market resilience. Take a look at history. The market has weathered countless storms before. Remember the 2008 financial crisis, the dot-com bubble burst, the March 2020 pandemic crash? Each time people thought it was the end. But guess what? The market recovered. It always does. The key is to stay the course. Don't let short-term volatility derail your long-term investment goals. Remember, time in the market is more important than timing the market. Your action plan. Turning crisis into opportunity. So what should you do now? First, take a deep breath. In times of crisis, it's essential to remain calm and composed. A deep breath can help clear your mind and prepare you for the steps ahead. Remember, we've got this. Now is the time to be proactive, not reactive. Being proactive means taking control of the situation and making informed decisions, rather than just reacting to events as they unfold. This mindset will empower you to navigate through the crisis effectively. Here's your action plan. A well-thought-out action plan can be your roadmap during uncertain times. It provides clarity and direction, helping you stay focused on your goals. 1. Assess your risk tolerance. Understanding your risk tolerance is the foundation of any investment strategy. It determines how much uncertainty you can handle in your investment portfolio. How much risk are you comfortable taking? This involves evaluating your financial situation, investment goals, and time horizon. Are you willing to take on higher risk for potentially higher returns? Or do you prefer a more conservative approach? Are you a buy-and-hold investor, or do you prefer a more active approach? Buy-and-hold investors typically seek long-term growth and are less concerned with short-term market fluctuations. In contrast, active investors aim to capitalize on market movements through frequent trading. Understanding your risk tolerance is crucial for making sound investment decisions. It helps you choose the right investment strategy that aligns with your comfort level and financial goals. 2. Diversify your portfolio. Diversification is a key principle in risk management. By spreading your investments across various asset classes, you reduce the impact of any single investment's poor performance on your overall portfolio. Don't put all your eggs in one basket. This age-old adage holds true in investing. Diversifying your investments can help protect your portfolio from significant losses. Spread your investments across different asset classes like stocks, bonds, real estate, and commodities. Each asset class has its own risk and return characteristics, and combining them can create a more balanced portfolio. Diversification helps mitigate risk and protect your portfolio from market volatility. It ensures that your investments are not overly exposed to any single market event or economic downturn. 3. Consider this a buying opportunity. Market downturns, while challenging, can also present unique opportunities for investors. Remember, market downturns can present excellent buying opportunities. When prices are low, you can purchase quality assets at a discount, potentially setting yourself up for significant gains when the market recovers. If you've been eyeing a particular stock or sector, now might be the time to consider adding it to your portfolio at a discount. Conduct thorough research and ensure that the investments align with your long-term strategy. By turning crisis into opportunity, you can navigate through challenging times with confidence and resilience. If you're enjoying this and want a deeper dive into spotting undervalued stocks, I put together a free guide for you. 7 proven steps to spot undervalued stocks like a pro. You can grab it from the link in the description below. Stay informed, stay invested, stay ahead of the curve. The market may be unpredictable, but that doesn't mean you have to be caught off guard. Keep an eye on the news, monitor your portfolio, and don't be afraid to adjust your strategy as needed. And most importantly, don't panic. Remember, we've been through this before and we'll get through it again. The market will recover and so will your portfolio. Now go out there and make some money. And don't forget to like this video and subscribe to our channel for more timely market updates and investing advice.